So in 2001, late 2001, Enron, if you guys remember this, goes back many years now, Enron totally collapsed. And it resulted in about $80 billion in destruction of value. Shareholder equity, $70 billion got wiped out in the Enron collapse. Employee pensions, 401k losses was between 1.2 and 2.1 billion dollars that evaporated. Creditor losses, 63.4 billion in assets on paper, and the creditors got about 20 cents on the dollar. That was 10 to 15 billion dollars. And the secondary collateral damage, Arthur Andersen, the huge accounting firm, collapsed, and there were also massive counterparty write-downs and class action suits. So what led to, without getting too much in the weeds, what led to the collapse of Enron? It was the way that the debt, or private credit was being structured. And what they were doing is they were using these special purpose entities, basically accounting shenanigans. Enron created hundreds of off-balance sheet entities. The purpose was to hide the debt, inflate the earnings, and push losses out of sight. Hold that thought. I'm going to get to what's happening right now with the funding of trillions, billions, and it's going to be trillions eventually, of dollars into the AI data center credits or debt obligations. So purpose was to hide debt, inflate earnings, and push losses out of sight. Management treated the special purpose entities like a trash bin. Bad assets went in, fake profits came out. To share with you what Michael Burry is saying in the last few days, just before he closed his $155 million asset management firm, about the hyperscalers and the AI and what they're doing with their, allegedly doing with their earnings. It's going to cause this whole thing to come down. Like I said in the thumbnail title, this Enron 2.0 is underway, okay? And it's going to make like Enron 1.0 seem like a warm-up act. And of course, they were playing mark-to-market games. Again, I'll share this what's happening right now. And Burry's warning, Enron booked multi-decade energy contracts as instant profits on day one based on fantasy valuations. Revenue numbers became fiction supported by no cash flow. The last few days I've been sharing with you all these phantom entities that are basically not, or have tremendous debt obligations, but they're not showing any net profits or real cash flow. Of course, Wall Street and all these, darlings, these AI stocks are going up on the expectation that the AI data centers will eventually produce massive cash flow. This is once Wall Street expects continuous growth, you're trapped. And once one quarter is bad, the whole thing collapses. Okay, so that's what basically happened, what's going on with Enron. Now fast forward to late 2025, where we're here present time, as every day we're seeing massive, a large amount of news stories every day about huge collaborations with these, AI companies and tech companies, and what they're doing to finance this AI trade to build out these data centers. Case in point, out of Reuters, just on November the 4th, Meta agreed to a $27 billion financing deal with Blue Owl Capital. Blue Owl Capital, another one of these non-depository, non-bank financial institutions, right, for its biggest data center project using a complex structure, and here we go, that keeps the debt off its own books. So Meta will be able to keep that debt off its books. Look exactly what they were doing back in the early 2000s with Enron. JP Morgan estimates AI-linked companies account for 14% of its investment grade index, surpassing U.S. banks as the dominant sector. All right? Think about that. 14% of JP Morgan's investment grade index is linked to AI companies. You guys think this is not going to be massive as it collapses? So let me explain to you what the big tech firms are doing. And I'll share with you two stories that I think are very important. So hang with me. If you guys enjoy the content, please subscribe to the channel. If you're not subscribed, I appreciate everyone watching. And to those subscribers that have been with me from the beginning, I appreciate you. To all the new subscribers, thanks for being here. So big tech firms are raising billions of dollars via private credit and structured vehicles, okay, rather than their traditional corporate debt lines, all right? Then these deals are structured through, you guessed it, SPE, special purpose entities, or SPV, special purpose vehicles. Same thing. Joint ventures. Just talked about Meta's joint venture with Blue Owl, okay? So the tech company contributes the asset, the data center, compute hardware into the SPV. Private credit funds provide debt, okay? And sometimes they try to keep, they do it, again, it says to keep the debt off its balance sheets, the parent company like Meta, okay? Accounting and regulatory sources confirm that off-balance sheet entities allows liabilities to be hidden from the main balance sheet, and this kind of structure was historically abused. Here we go, Enron. Okay, that's according to Investopedia. So let me share with you the two stories I have that bring this full circle and why it's important that everybody pay attention to this, all right? You think Enron's losses were steep. Look at Enron was $80 billion. Right now, Meta alone, just their partnership or joint venture, right, with Blue Owl is 28 billion, all right? And it's going to keep going from here. So out of the Business Insider just a couple days ago, and this got some coverage on mainstream media, but not too much. Michael Burry, the Big Short, latest argument against hyperscalers like Meta and Oracle echoes one made by an investor who shorted Enron. Burry, who recently came out of social media hiatus, says he's concerned about hyperscalers, the mega cap tech firms like Meta, Oracle, Microsoft that are shelling out big on AI infrastructure. Okay? Those investment plans could result in painful losses for those companies. Burry suggested, given that semiconductor chips like NVIDIA's have a relatively short lifespan. And don't forget, they're booking on a much longer lifespan to generate massive returns on these investments to pay off these debts. Massively ramping capital expenditure, CapEx, through purchase of NVIDIA chips, servers on a 2 to 3 year product cycle should not result in the extension of useful lives of compute equipment. Yet this is exactly what all the hyperscalers have done, according to Burry. Let me read to you what a hyperscaler is, okay? I had to dig into it a little bit myself. So hyperscalers are the mega cloud, this is from ChatGPT, are the mega cloud operators that build and run massive industrial scale compute infrastructure. Think Microsoft, Azure, Google Cloud, and Meta, Oracle, and Alibaba. Think about the massive size of these companies involved. They are called hyperscalers because they can scale compute, storage, and networking capacity globally on demand at insane volumes. So who are the hyperscalers? Number one, the developers. They build the biggest AI-centric data centers on the planet. Number two, the buyers. They are the largest global buyers of GPUs, networking gear, and power. They sign multi-billion-dollar orders with NVIDIA, Broadcom, Cisco, etc. Okay? The circle of doom, right? Number three, they are the customers of private credit. Here we go. Hyperscalers often need fast capital to expand AI data center infrastructure, and they basically go to the private credit funds to get the money. And the private credit funds get the money from JP Morgan, life insurance companies, pension funds, right? And of course, the hyperscalers also become the tenants. They don't own the facility, they lease it back. Remember I shared yesterday about CoreWeave? It was going to be the tenant, and some of the creditors in that deal are questioning whether or not CoreWeave will generate enough income, right? Because they're losing now, they're losing their butts. Will they be able to generate enough income to service their debt obligations to pay their lease? One of their obligations is pay their lease in these huge AI data centers. Okay, so that's what a hyperscaler is, and what the different, let's say, they are the buyers, they are the tenants, they are the customers of the private credit. So continuing with the article from Reuters, where Burry is saying he estimates that Meta, Google, Oracle, Microsoft, and Amazon, 5 hyperscalers and some of the biggest names in the AI trade, would understate. Now, this is his position, but do you think it's coincidental that he closed his fund down and he's announced now something is going to be coming out, a big announcement on November 25th of this month, just here in a few days? Says that those companies, he's alleging, would understate depreciation by $176 billion between 2026, this next year, and 2028. This is going to come down, folks. By 2028, Oracle, he says, will likely overstate its earnings by around 26%, and Meta could overstate earnings by around 20%. He speculated without elaborating on the calculations. But it gets worse, and he says more details coming with an announcement on November 25th. And then in closing on this article, his warning sounds, it says, similar to what Jim Chanos, the famed Enron short seller, said about the AI trade. And Chanos says he was concerned about the billions of mega cap tech firms, the billions that mega cap tech firms are shelling out on AI hardware. Amazon, Meta, Microsoft, Alphabet, and Apple are on track to spend a collective $349 billion on CapEx this year, much of which is directed towards AI infrastructure. And Chanos, the Enron short seller, said we're getting to the point now where within a year or two, some of these large companies are going to start having to make some very uncomfortable decisions as to when and how they will monetize AI and what the returns will ultimately be on this massive spending. He says because the chips basically depreciate over 2 years. Well, I will tell you, I guarantee you those lease obligations, okay, are much longer than 2-year terms on these massive AI data centers. So he says, Wall Street analysts have been thinking, well, the article concludes, Wall Street analysts have been thinking about the depreciation issues since at least last year. An analyst told Business Insider in November that the impact on earnings from how costs are calculated and how hardware depreciates is a potential time bomb at the heart of the AI trade. Investors are taking stock of the market's monster gains. Many also recognize that AI monetization plans for many firms is unclear. It's unclear, yet you have JP Morgan allocating 14%, okay, of that one category into this industry. You've got massive funds flowing in from all the big companies, life insurance companies. So guys, this is serious stuff. And then another article out of Reuters from yesterday, Michael Burry, the big short, closing his hedge fund. All right, and he basically said that he's closing Scion Asset Management, and he says my estimation of value in securities is not now and has not been for some time in sync with the markets. Now, yes, he is a short seller, okay, one of the biggest names out there, so he gets a lot of flack for it. But can you honestly tell me that he's not onto something here? Come on. I mean, if you see how this is all laid out, they have no plans to really monetize this stuff. And if let's say the useful life of this hardware is a couple of years, how are they going to repay the debt? And when's it going to explode? 2026, 2027, 2028. My estimation of value, he says, has been for some time not in sync with the markets. It's a polite way of saying that this thing is going to crash, okay? So he closed down Scion, which managed $155 million in assets as of March. And he says, on to, his quote was from X, Burry says, on to much better things, November 25th. That'll be interesting to see what it is that he comes up with, okay? And again, we shared, I think, on a video last week, the news was out. Michael Burry took a short position against Palantir and against NVIDIA. All right, so you don't think for a second he and his teams are not laying out and seeing, what is happening here? You're going to hear the term, and one of the subscribers brought to my attention yesterday, you're going to hear the term data center credits come up. And so I pulled what that is real quickly, and I'll read you the definition. Because it's confusing a little bit. Data center credit in this AI context simply refers to debt financing. That's all it is. It's not equity, not ownership. Okay, there's no credit. It's loans, notes, and financing facilities made to data center operators or data center projects. Okay, it says there's no equity upside. You're underwriting the borrower's ability to service debt from data center cash flows. And so it comes full circle There is a huge assumption and huge bets being placed right now, billion and trillion-dollar bets, that the cash flows will be there to support all of this. I don't know. I'd like to get your thoughts and comments. We're a little bit long today, but I wanted to, delve into what really is a complex, a bunch of overlapping concepts and models that appear to be patterning exactly off of what happened with Enron. So to say that no lessons are ever learned is an understatement. The $80 billion that was lost during Enron, I don't know. Pick any number you want. What do you want the number to be? 500 billion, a trillion, 5 trillion, 10 trillion. What will the losses be? Okay, how many people will get wiped out? Of their equities, of their retirement portfolios. I don't know. I know it sounds doom and gloom, but this is actually happening. Thanks for watching. If you enjoy the content, leave me a like. Subscribe if you're not subscribed. Thoughts and comments, I do enjoy receiving those and reading them, time permitting. It's getting a little bit more difficult now to keep up with you guys, but I appreciate it. And with that being said, I will talk to all of you soon. Bye.